Hi, you guys. I'm Phil Talent from Real One Investing, and today we are going to be talking about the index fund bubble that's been building over the last few years. And I'll tell you, it's no secret, over the last decade, massive amounts of money have been pouring into these passively managed funds around the world, these ETFs that are mimicking an index. And this has caused a really strange effect in the market. Not only has the buying rocketed the S&P 500, it's shoved it up to record highs, it's also caused trillions of dollars to get invested in big name companies like Microsoft, Google, Amazon, not necessarily because of underlying business fundamentals, but simply because these companies fall within the world's major indexes. But what's the consequence of that? And are we facing a giant ETF bubble that's ready to bust? That's the big question. Now, over the past decade or so, trillions of dollars have flooded into the stock market. And these days, the majority of that money is being invested in passive investing. This means investors are not necessarily thinking about which companies they are buying, that is the fund managers. They're just buying the index. Whatever that index is doing, they mimic it. They're simply putting money into the market in a diversified way and hoping that the future looks somewhat like the past. But this has created one particular issue, and that is that many well-known investors are thinking that we have a major problem. It has disrupted what we call price discovery. Now, price discovery is the market's natural process of determining the fair price of a stock based on supply and demand. In a healthy market, active buyers and sellers are constantly assessing companies. They're looking for earnings, they're looking at growth prospects, they're looking at the risks, and they're setting the price of the company accordingly. But with such a high level of passive inflows, buying everything in the index, regardless of the valuation, that process gets distorted. In fact, Michael Burry, you remember this guy, he's famous for predicting the 2008 housing market collapse, the collapse of all those bonds. He was really made famous in that movie, The Big Short, and then the book, The Big Short. He's been warning about this for several years, going all the way back to 2019. Michael noted that passive investing has removed price discovery from equity markets, and that, quote, the simple models that get people into indexes or ETFs do not require the security level analysis that's required for true price discovery. This is super important because this is never happened before. So over the past few years, we've seen the effects of this whole market distortion firsthand. Passive investors are pushing the prices of the world's biggest companies to the moon. The S&P 500, the index that contains the 500 largest companies in America, that thing just continues to go hit all-time high after all-time high. And in 2025, we are seeing the prices of these stocks begin to meaningfully detach from their underlying earnings. Now, the last time I saw this was 1999, when Yahoo was valued at something like 11,000 PE ratio, just completely disconnected from reality. And I feel like we're rolling into that bubble very strongly right now. So right now, everything's okay, the market can race ahead. But remember, for it to be justified, it has to be ultimately matched by a simultaneous increase in business performance. At the moment, you guys, what we're seeing is a substantially higher price for the market than what the earnings suggest should be the case. Now, one way to measure this thing is by looking at a little metric called the Shiller PE ratio. Now, this was done by a professor at Yale, and he got the Nobel Prize in economics for it. Now, this is a price-to-earnings ratio that compares the current price of the S&P 500 with the average inflation-adjusted earnings of all of those companies over the past 10 years. Now, for context, the long-term historical average that has been in that index shows that investors are usually willing to pay about 17 times earnings to own the S&P. Now, by the way, long-term, we're going all the way back to the 1800s here. Now, today, the Shiller PE sits at 38, which is more than double that average. So around 2008, the Shiller PE did correct itself in that big crash we had back to that long-term average. But as you can see, in the last couple decades, the investors have been willing to pay increasingly higher multiples to own the market compared with the underlying earnings. And today, that means investors, get this, are essentially waiting 38 years to get their money back from an investment in the S&P 500. The market earnings yield, and what that is the interest rate, kind of like on a bond, right? So it's the interest rate on the market is what you get from earnings. It's currently 2.6%. That's what you get from the earnings for buying the market at this price, when you can get a 4.5% yield on a risk-free government bond. this starts to disconnect from reality. Now, this reality has even led Monesh Prabrai, who's a really, really good investor, one of the best investors in the world, and he made this statement in a recent interview.
Normally, I would say put it into an index, right? The index, like the S&P, is overheated. We can't go there right now. Circa 2025, we cannot go into the S&P. Okay, maybe 2035 we can, but not 2025.
All right, the short of it, while passive investing, in theory, is a reasonable strategy for ultra long-term investors that don't know any better, which is many people, the popularity of the approach over the past few decades is causing an explosion in valuations of all the big name companies that sit within the world's major indexes. So is it a bubble? Well, yes. And in fact, you could argue that the definition of a bubble is investors en masse buying into an asset class without considering the fundamentals. That's definitionally a bubble. And that's how all bubbles form, from tulips to this one. But the bigger question here is, what are the likely consequences of this bubble? Because here's the thing about index funds. While they're designed to track the index when the market goes up, 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 they're also designed to follow the index the other way as well when the market goes down. So this presents a real problem for investors the next time the market takes a big drop. Why? Because these ETFs are indexed to the market. If the market goes down, the ETF fund managers are must sell the stocks in their fund to stay with the index. There's no valuation judgment whatsoever. That sort of automated selling, that's essentially what it is. It's automated selling can trigger a massive drop in the market. And why would that happen? Well, it comes down to what we call behavioral finance. In the short term, the stock market is driven far more by emotion than by logic. When things are going really well, euphoria can push prices higher and higher. But when things start to, kind of turn bad, then fear can take over, and it can take over fast. 80% of the stock market ownership right now is in the hands of institutional investors who run those funds, those ETF funds, and so on. The problem we are facing today is that most of them know the market is massively overpriced, and they all want to be sure that they get out before the other guys do, before it crashes. So essentially, those who are not managing an ETF, they are going to be really quick to beat the ETFs out of the market. Kind of like the people who smell smoke in a theater and are the first to run for the door. Of course, that fast exit to the door creates fear for those who are still sitting. And worse, the ETF guys have to sell to stay with their market index as it goes down. And now, think about those 75 million baby boomers who drove the market up by saving for their retirement. And as the market drops, this huge cohort is going to aggressively sell. They cannot afford to wait and see if this whole thing comes back up like they've been doing for 30 or 40 years. Not this time. They are really going to feel the fear when the headline turns negative, and this is going to make the boomers far more likely to just panic sell. And when that happens, guess what? That's right. The index funds, those ETFs, no choice in the matter. They have to sell to stay with the index, even when it's going down like a brick. And when investors get scared, that wave of selling can trigger a chain reaction. Since the index funds are holding huge positions in these large companies in the S&P 500, their selling can push those share prices down so rapidly, much more sharply than they rose during those years of relentless index fund buying. In other words, the same mechanism that helped fuel the boom, that is baby boomer retirement money into these ETFs, could very well amplify this bust. Now, this effect is also compounded by another factor we're seeing in 2025, which is the concentration in the S&P 500 is stunning. When the S&P 500 is technically an index of about 500 companies, the reality is, though, that the top 10 stocks, the Mag 7 plus 3, account for about 40% of the weight of the index. This means that almost half of every dollar invested in the S&P index is going straight into a handful of mega cap companies like Nvidia, Microsoft, Apple, Amazon, Meta. The danger here is that if even a few of these companies stumble, whether it's disappointing earnings or excessive spending on AI data centers, regulatory changes, or shifts in technology, the impact on the index could be severe. because of their outsized weighting, right? Now that sell-off gets going in just one or two of these names, it could drag down the entire index, and that could pull millions of index funds investors along with it. Now, of course, this all remains to be seen. And right now, there are no signs of an impending stock market crash other than an insanely huge ETF stock market bubble. So for the last part of this video, I really wanted to dive into what we can do about it. How can we ensure that we're not impacted by the bursting of an ETF bubble? And the answer to that is by learning what I learned. I've learned it, 40 years ago, and I've been applying it ever since. But this can make you rich in a market like this. This is the kind of market where this sort of investing is stunning in its overall impact on your life. So this kind of market, if you know what you're doing, can make you very, very rich, can get you to generational wealth. And if you don't know what you're doing, it can make you poorer. So instead of following the herd and investing every dollar into a broad market tracking ETF, come on, how about learning to invest the way the best investors in the world do, the way Warren Buffett's been doing it for 70 years? What we do is we go hunting for individual companies we understand with wide moats that are run by really good, honest managers. And then we wait, right? We get a list and we wait and we wait until those companies are selling at a price that gives us a huge margin of safety. And here's the magic, you guys. When you invest that way, what's happening in the broader market really doesn't matter that much. You can go to sleep at night and 10 years later, you'll be on your way to generational wealth. If you think the S&P 500 is too expensive right now, okay, cool, so do I. And so does Buffett. He's sitting on $344 billion in cash in short-term bonds. He's just waiting for this market drop so that these rare, beautiful, wonderful companies come on sale. And that is an incredible market gift. They're our chance to grab great businesses at a really steep discount. Doesn't come along very often. So while everyone else is panicking, we're sitting there waiting with cash. We can be calm. We can be patient. We can just be ready to buy. And if an ETF bubble bursts, well, we're not the ones running for the exit. We're the ones walking in with a shopping list. And finally, you guys, before I sign off, if you'd be interested in really learning this stuff, learning this way of investing, I would absolutely love it if you'd join us at our next upcoming workshop. I teach for 3 days entirely online. We go through everything you need to know to become a rule number one investor like Warren and Charlie and me. We have over 25,000 graduates who will tell you this is simply the best investing education in the world. We have the NPS scores to prove it, averaging 82, far better than Harvard or Yale's MBA programs. Please check out the links in the description and pinned comment to learn more, and we'd love to see you there, you guys. Thanks for watching. Now go play.